Welcome to Market Monday from the investment team in the trust department at the First National Bank. We'll kick things off today with a look at the economy and then move into implications for the equity markets, interest rates, and portfolio positioning in 2024, which is turning out to be a pretty interesting year by anyone's standards. And why is it interesting? Well, the data keeps coming in showing a more robust than expected economy, and that has implications for the Fed. You know, the Fed is not necessarily in any sort of position to cut rates by, 25 basis points in March, like had been the expectation on media and other analyst expectations, including, the Federal Reserve's own dot plot, which came out and shows that they're expecting to do 3 rate cuts this year. Some of that may be off the table because of the strength and robustness in the labor market specifically. At the beginning of the month, we had basically expected number of initial jobless claims. That's not really, the variance there was not really significant. The sentiment indexes are coming in stronger, and the jobs number, the change in non-farm payrolls at the beginning of the month was just crushed it. I mean, 353,000 jobs created in January versus an expected 185,000. That's nearly twice the expectation, and that argues that the economy is still very strong, even in the face of this pretty unprecedented rate hike cycle. And, the market seems to agree that everything is firing on all cylinders, but we'll get to that in a little bit more detail when we cover markets. That said, sentiment indexes are coming in strong. Durable goods orders, factory orders are coming in strong. The ISM services index is coming in strong. And wholesale trade sales came in at more than double the expected percentage. The expectation was for 0.3% growth there. We got 0.7% growth, and the inventory stayed pretty flat in terms of expectations at 0.4%. So what's happening there argues that, retailers are still buying inventory from wholesalers in the expectation that the wheels are going to keep turning in consumer spending and therefore economic growth. Later this week, we're going to get CPI, the Consumer Price Index, expected to show a 0.2% rise on a month-over-month basis in January. Now, 2.9 will be the annual number, and those are expected to be, pretty significant decelerations from the prior report, but not so fast. We're not sure we're actually going to see that. So we'll take a peek for it. We'll be on the lookout for it, but we don't know that that's going to happen. We also are going to get revisions to PPI, and that might be an interesting number, especially if it, shows further shrinking in there. Because, if we've got consumer prices starting to come under control, but still growing by this 2.9% on the year-over-year basis, and we wind up getting PPI revisions that show even lower growth than the negative 0.2% it was last month, we could see corporate margins increasing by even more than they already have. And we're talking about that. So CPI, you could represent as consumer costs or sales at corporations, and producer prices represent input costs. So this situation where consumer prices are rising at a much faster rate than the producer prices argues that corporate margins are likely to keep increasing, and that may in fact be one of the drivers of the recent bull run in equities, because ultimately stock prices are a function of earnings, which is sales minus costs. So we'll be attentive to that. We get more information on the labor market. We get the PPI here at the end of the week. That's going to show expected growth of 0.6% versus the prior period of 1%. And on the month-over-month basis, that's supposed to show a slight increase of 0.1%. Now, again, we need to watch carefully as to what's really happening here for that idea of what's happening in corporate margins. The leading economic indicators will come out on the 20th. That's expected to show a decline of 0.3%. And this is interesting because that leading index tends to forecast recessions, and it's been negative for quite some time. So we'll be watching that as well. More housing market, consumer confidence, and the consumer is 2/3 of GDP. We'll get GDP also for the fourth quarter. That's going to be, a revision, and perhaps that changes, showing, slowing from the 3.3 robust growth that it had before, or what's more likely, given all the other data, that it's going to show a higher growth than what was shown on the first reading. We get incomes, and then, there are even more events toward the end of the month. Let's click there like it says. Yeah, home sales and the Chicago PMI, so that's more sentiment information, and that rounds out our month. So let's talk about equities. Wow, how about that S&P 500, which does nothing but keep going up in the face of all of this news, and largely, in our opinion, the corporate profit situation that's driven by margins is probably a big factor in that bullish outlook that's driving this run in equities. So this is a bull market. This does not want to go down. When there's so-called quote unquote bad news, the market is still going up. And when there's good news, it's really going up. So we're taking that as a sign that even in the event that we do see a significant slowdown in the economy, and we are expecting that later in the year, a mild recession at least, we're not sure that the equities will fall in tandem with that like they usually do. That relationship may be uncoupled in a rare instance this time because of the margins situation. In any case, we're looking at a bullish run in stocks and we don't have any issues right there. Looking at the Treasury curve, that's moved higher slightly in the belly of the curve, indicating that some of the pressure in the economy is coming out. So, in fact, some of these voices on media and in the analyst community may be right. We may be seeing the beginning of a softer landing than anticipated, although historical odds on that are not going to be with that outcome being likely. That said, the 5-year, 10-year paper is all above 4%, and that's relatively flat in that zone. And we're going to take 10-year paper being at 4% to indicate that the market thinks inflation is going to remain around 3.5% to 4%, using the 10-year as a break-even rate for sophisticated investors. Then we're going to look into corporates, and corporate yields are great. They're lower than what they've been before in terms of the beginning of last year or the year before, where rates just came up very vigorously over the past, say, 18 months. And looking at the curve now, though, they are starting to rise a little bit again. And 5-year paper is 4 3/4, 10-year paper is just over 5%. And this is great if you're on a fixed income and you're living on bond investments. Or this is great if you're a balanced type of investor that has stocks and bonds in order to lower portfolio risk, where now you're getting paid meaningful yields in order to take that risk off the table. So this is a good situation for fixed income investors in high quality corporate paper. And with corporate margins in general increasing because of the price situation in input costs versus output costs for companies, this is a very good time to be a corporate bond investor, even though yields and the spreads to the Treasury are pretty low comparative to history. But with that said, we're not focused as long-term investors on the short-term stuff that's going on. We want to pay attention to all these data points. We want to be aware of what's going on in the stock market and in the fixed income world. However, our view needs to zoom out. So we'll look more in the long term and seek to not really participate and not panic when things are coming down and not get overly excited when things are going up like they are now. If you have questions about the portfolio, if you have questions about our outlooks on markets, if you have questions about the implication of what's happening in the economy on your portfolio, feel free to reach out to us. We're here to talk. We're happy to do that. Hope you found this video useful. Thanks and have a great day.